Welcome to the Deep Dive. Today, we're going to tackle something that can be both fascinating and a little intimidating. Financial statements. We're going to try to unlock those secrets hiding in the numbers. You've provided us with Financial Intelligence by Karen Berman, John Case, and Joe Knight. Seems like a pretty great guide for this journey.
Yeah, this book is a classic for a reason. It really breaks down those complex financial concepts, in a way that anyone can understand.
Yeah, one of the first things that jumped out at me was this idea that finance and accounting aren't just cold, hard numbers. The authors, they suggest that there's an element of art to it as well. What do you think about that?
It's a really crucial point. Think of it like this. You might see a company's profit as a solid figure, right? But how they actually got to that number involves choices about things like how they depreciate their assets or recognize revenue. There's room for interpretation, and that's where the art comes in.
So it's not as simple as just adding and subtracting numbers.
Exactly. Remember that example in the book about Xerox manipulating its revenue recognition? It just shows how much those seemingly technical decisions can influence the final figures.
Oh yeah, that example really made me think about how much power lies in understanding these nuances. It's like learning a secret code. So let's talk about the three major financial statements the book dives into: the income statement, the balance sheet, and the cash flow statement. Let's start with the income statement. Maybe you can help us unpack this one.
Think of the income statement as a business's report card for a specific period. It shows how much money the company brought in, which is the revenue, how much they spent, expenses, and ultimately if they made a profit. Sounds simple enough, right?
On the surface, yes, but I'm guessing there's more to it.
Absolutely. The book does a great job of diving into those less obvious details like the concept of revenue recognition. It's not always straightforward when a company can actually claim they've earned revenue, and different methods can paint different pictures of a company's performance.
That makes sense. Now, how about the balance sheet? It always seemed like a bit of a mystery to me.
Imagine you're listing out everything you own, like your car, your savings, maybe even some cool sneakers. These are your assets. Then you list out everything you owe, maybe a car loan or a credit card balance. Those are your liabilities. The difference between the two is kind of like your net worth. A balance sheet does the same thing for a company. It's a snapshot in time, showing what the company owns, what it owes, and what's left over for the owners.
So even things like deciding whether an expense should be categorized as an operating expense or a capital expenditure can make a big difference on a company's balance sheet.
You got it. It's not just about the numbers themselves, but understanding the choices behind how they are classified. That's where developing your financial intelligence comes in.
Okay, so we've got the income statement and the balance sheet. What about the cash flow statement? What makes it different from the others?
The cash flow statement is all about tracking the actual movement of cash, both in and out of the business. It's a really important piece of the puzzle because a company can be profitable on paper, meaning their income statement looks good, but still face serious problems if they're not managing their cash effectively.
The book uses the examples of Sweet Dreams Bakery and Fine Apparel to illustrate this, right?
Yes. Those examples really highlight how a business can look great on paper but struggle with cash flow if they have lots of unpaid customer invoices or have to pay suppliers up front.
So it's like the old saying, cash is king.
Exactly. You need both profit and cash flow to thrive. The cash flow statement helps us understand how a company is generating and using its cash, which can be just as important as understanding its profitability.
I'm starting to see how these three financial statements each tell a different part of the story about a company's financial health. It's like piecing together a puzzle.
That's a great way to think about it. And to help us analyze these statements even further, we can use a set of tools called financial ratios. These ratios allow us to dive deeper into a company's performance. We can compare it over time, against competitors, or even against industry benchmarks.
Okay, I'm intrigued. Tell me more about these ratios. What kind of insights can we glean from them?
Well, there are different categories of ratios. Profitability ratios like gross margin and return on equity tell us how effectively a company is generating profits from its sales and assets.
So those would be important for understanding how well a company is performing, right?
Definitely. But we also want to consider things like leverage. Leverage basically means how much debt a company is using to finance its operations. Leverage ratios like the debt-to-equity ratio help us assess the company's financial risk.
Right, because too much debt could be a problem, especially if the economy takes a downturn.
Exactly. And then there are liquidity ratios like the current ratio and quick ratio. These indicate a company's ability to meet its short-term obligations. Basically, can they pay their bills? We also have efficiency ratios. These can give us insights into how well a company is managing its assets, like inventory and receivables.
It sounds like these ratios are like having a whole toolkit for dissecting and interpreting those financial statements.
They are, and each ratio tells a specific part of the story. For example, a high inventory turnover ratio, might seem like a good thing, but it could also be a red flag if it's because the company is constantly running out of stock.
So we need to look at these ratios in context and consider what's driving those numbers. What else can we learn from these financial statements?
One of the most important things is understanding a company's cash flow dynamics. The book introduces this concept called the cash conversion cycle, which measures the time it takes for a company to convert its investments in inventory and other resources into actual cash flow from sales.
So a shorter cash conversion cycle would mean they're turning their inventory into sales and collecting their receivables more quickly, right?
Exactly. This means they're efficiently managing their working capital, which is that crucial balance between cash coming in and cash going out.
This is all fascinating stuff, but I have to admit, it can feel a little overwhelming. There are so many different pieces to consider.
Don't worry, it's like learning any new skill. The more we break down these concepts and see how they connect, the more comfortable you'll become with the language of finance.
Speaking of connecting the dots, the book spends a lot of time talking about managing working capital, right?
Yes. Working capital refers to those current assets and liabilities that are always changing, like accounts receivable, inventory, and accounts payable.
So it's basically how a company manages its day-to-day financial operations.
Precisely. And effectively managing these elements can free up significant cash flow, which can have a huge impact on a company's financial health.
It's all starting to make sense. Now, I'm curious about the concept of economic profit. It seems like that's a little different than just looking at a company's profit on its income statement.
You're right. Think of it this way. Accounting profit is what you see on the income statement. It's based on generally accepted accounting principles. Economic profit, on the other hand, takes a broader view. It considers not only those explicit costs, but also what economists call the opportunity cost.
So it's like asking, are we truly earning enough to justify the resources we've invested in this business? Or would those resources be better used elsewhere?
Exactly. It pushes you to think about the bigger picture and consider whether the company is creating value beyond just covering its costs. It's a tougher standard, but it provides a more complete picture of a company's true performance.
This is all really eye-opening. It's making me realize that financial intelligence isn't just for people in the finance department. It's valuable for anyone, in any role.
I couldn't agree more. The more we understand these concepts, the better decisions we can make, and the more we can contribute to our organization's success.
Okay, so we've covered quite a bit of ground already. What else do we need to know about financial intelligence?
Let's dive back into that balance sheet we were talking about earlier. The book does a great job of unpacking some of those trickier concepts like goodwill and intangible assets, which can feel a bit like accounting magic if you're not familiar with them.
Yes, those terms always seemed a bit mysterious to me. Can you break them down for us?
Remember how we were comparing the balance sheet to a person's net worth? Well, goodwill is kind of like someone's reputation or brand value. You can't physically touch it, but it definitely adds value to a business, especially in acquisitions.
So if a company acquires another company for more than the value of its tangible assets, that difference would be considered goodwill.
That's a great way to think about it. It represents the value of things like brand recognition, customer loyalty, and a company's track record. But, as the book points out, valuing goodwill can be tricky. Remember that example with Tyco?
Oh yes, Tyco was accused of inflating its goodwill to make its acquisitions look more favorable, right?
Exactly. It's a reminder that we need to look beyond the numbers and try to understand the story they're telling.
It really highlights the importance of being financially intelligent and not taking everything at face value. What other tricky concepts do we need to be aware of?
Well, the book also talks about this concept called mark-to-market accounting. It requires companies to value certain assets, like stocks and bonds, at their current market price, even if they haven't actually sold them yet.
That sounds a little risky. What happens if the market takes a nosedive?
That's exactly what happened during the 2008 financial crisis. Many banks held mortgage-backed securities that were valued based on the booming housing market. But when housing prices plummeted, those assets had to be marked down to reflect the lower market value. This led to huge losses and played a big part in the meltdown.
Wow, that's a sobering example of how these seemingly technical accounting rules can have massive real-world consequences. It really underscores the interconnectedness of the financial system.
It definitely does. Another concept the book explores is leverage, which is essentially using borrowed money to finance investments and potentially boost your returns.
That makes sense. It's like using a lever to amplify your force. But I imagine there are risks involved too, right?
Absolutely. Debt can be a double-edged sword. If things go well, leverage can help you amplify your profits. But if things go south, your losses can be magnified too.
So how can we assess a company's level of leverage?
That's where leverage ratios come in. One of the most common is the debt-to-equity ratio, which compares a company's total debt to its shareholder equity. A higher debt-to-equity ratio means the company is using more debt relative to its equity, making it more leveraged.
So a high debt-to-equity ratio could be a red flag, suggesting the company might be taking on too much risk.
It's not always a bad thing. Some level of debt is normal and healthy for most businesses. But too much debt can make a company vulnerable to economic downturns or changes in interest rates. It's all about finding that balance.
That makes sense. What about liquidity? How can we tell if a company can meet its short-term financial obligations, like paying its bills?
Liquidity is essential for any business. The book discusses liquidity ratios like the current ratio and the quick ratio. These ratios use a company's most liquid assets, things like cash, accounts receivable, and short-term investments to assess their ability to cover their short-term liabilities.
So if a company has a low current ratio, it could be a sign that they're struggling to pay their suppliers or meet their payroll, right?
Potentially, it could be a symptom of cash flow problems or poor working capital management.
This all emphasizes the importance of understanding those cash flow dynamics. It's not just about being profitable, it's about managing that delicate balance between cash coming in and cash going out.
You're absolutely right. The book introduces this concept called the cash conversion cycle, which I think can be particularly helpful. It essentially measures how long it takes for a company to turn its investments in things like inventory into actual cash from sales.
So a shorter cash conversion cycle would indicate that they're turning over their inventory quickly and efficiently, right?
Exactly. It means they're not tying up too much cash in inventory that's just sitting on shelves, and they're collecting their receivables in a timely manner. It's a sign of a healthy, well-run business.
It's like a well-oiled machine with cash flowing smoothly through the system.
That's a great analogy. Now, since we're talking about efficiency, let's touch on the topic of working capital management, which the book delves into quite deeply. Remember, working capital refers to those current assets and liabilities that are constantly in flux.
Right. We talked about those earlier: accounts receivable, inventory, and accounts payable.
The book emphasizes that effectively managing these elements can free up a lot of cash flow, which can be incredibly valuable for a company's growth and stability.
It sounds like it's all about optimizing those short-term financial operations.
Exactly. For example, the book suggests that strategically managing your accounts payable, like negotiating longer payment terms with suppliers, can be a great way to preserve cash.
So you're essentially extending the amount of time you have to pay your bills, giving you more flexibility with your cash.
Exactly. But of course, you have to be careful not to abuse this strategy, as it could damage your relationships with suppliers and impact your reputation.
It's about finding that balance, right? Optimizing your cash flow while maintaining strong relationships with your business partners.
Precisely. The book also dives into the importance of inventory management, highlighting the costs associated with carrying too much inventory and the benefits of implementing lean manufacturing practices.
I can see how having excess inventory could tie up a lot of cash and potentially lead to losses if products become obsolete or spoil.
Exactly. It's not just about having enough inventory on hand. It's about minimizing waste and ensuring your inventory is turning over quickly.
So what are some strategies for achieving that?
Well, the book discusses this concept called economic order quantity, which sounds a bit intimidating, but it's simply a way of figuring out the optimal order size to minimize those inventory carrying costs.
So it's all about finding that sweet spot where you're meeting customer demand without tying up too much cash in inventory, right?
You got it. It's about striking that balance. The book goes on to explore how these concepts apply to various departments within a company, illustrating how the actions of managers and employees in different roles can directly impact those key financial metrics.
It really drives home the point that finance isn't just the responsibility of the finance department. It's everyone's business.
Exactly. The more we understand the interconnectedness of these financial concepts, the better equipped we are to make smart decisions that contribute to the company's overall success.
It's about developing a shared financial language that everyone in the organization can understand and use.
I couldn't agree more. Now, there's one more concept I'd like to touch on: economic value added, or EVA for short. It's a way of measuring how much value a company has created above and beyond its cost of capital.
So it's kind of like a measure of how efficiently a company is using its resources to generate returns for its investors.
Yes. Think of it this way. Investors provide capital to a company with the expectation of earning a return on their investment. EVA measures whether the company is actually earning more than what investors require for taking on that risk.
So if a company has a positive EVA, it's essentially exceeding investor expectations and creating real value.
That's right. It's a sign that they're effectively deploying their resources and generating attractive returns.
This brings up an interesting point about understanding the investor perspective. They're not just looking for any profit, they're looking for a return that justifies the risk they're taking.
Absolutely. And the book does a good job of delving into those key metrics that investors focus on, like earnings per share, free cash flow, and the price to earnings ratio.
These are all terms I've heard before, but I'll admit I don't always fully understand them.
Well, earnings per share, or EPS, is basically the portion of a company's profit that's allocated to each outstanding share of common stock. It's a way of measuring a company's profitability on a per-share basis.
So a higher EPS generally indicates stronger profitability, right?
Exactly. Then we have free cash flow, which represents the cash that a company has left over after paying for its operating expenses and capital expenditures. It's a key metric for investors because it shows how much cash a company has available to reinvest in the business, pay dividends, or reduce debt.
It's like the financial fuel that allows a company to grow and create value for its shareholders.
That's a great way to put it. And then there's the price-to-earnings ratio, or PE ratio, which compares a company's stock price to its earnings per share. It's often used to assess whether a stock is overvalued or undervalued.
So a high PE ratio could suggest that investors are optimistic about the company's future growth prospects?
Exactly. But it's important to remember that the market can sometimes get ahead of itself. So it's crucial to consider other factors as well, like the company's financial health, industry trends, and overall market conditions.
It's like we're piecing together a puzzle, using all these different pieces of information to get a clearer picture of a company's true worth.
That's a great way to think about it. The book also makes a point of distinguishing between a company's market capitalization, which is its value in the stock market, and its book value, which is the value of its equity on the balance sheet.
So those two figures can be quite different.
They often are. Book value is based on historical accounting data, while market capitalization reflects the market's perception of the company's future potential.
It's like the market is saying, we're betting on this company's ability to generate future profit.
Precisely. The book concludes with a powerful call to action, urging companies to foster a culture of financial literacy and transparency.
It's about empowering employees at all levels to understand those numbers that drive the business, right?
Exactly. They advocate for sharing financial information more widely within organizations, breaking down those silos between the finance department and everyone else, and creating a shared language and understanding of finance.
That makes a lot of sense. The more people understand the financials, the better decisions they can make.
Right. They even suggest incorporating financial literacy into employee training programs and using visual aids like dashboards and scoreboards to track key metrics and communicate financial performance more clearly and engagingly.
It's about making finance more accessible, relatable, and even a bit fun, so that everyone can contribute to the company's financial success.
Exactly. And the book emphasizes that this kind of financial empowerment can benefit not only our professional lives, but also our personal finances.
That's a great point. As we've been discussing these concepts, I've been thinking about how they could be applied to managing my own personal budget. It's like shining a light on those areas where I could be more financially savvy.
It's all about making those financial decisions with more awareness and intention, whether we're talking about business or our personal lives. This deep dive into financial intelligence has certainly expanded my own understanding of finance and accounting.
Me too. It's amazing how much clarity and confidence you gain when you start to understand the language of finance.
It's like a whole new world opens up, full of possibilities.
We've explored the three major financial statements, dug into those key ratios, and even learned how to approach those complex return on investment calculations for capital expenditures.
And we've learned to look beyond the surface of those numbers, question those underlying assumptions, and really understand the story those financial statements are telling.
It's like becoming a financial detective.
I love that analogy. It really captures the essence of what it means to be financially intelligent.
This deep dive has been a real journey of discovery, and we hope you found it as valuable as we have.
Remember, financial intelligence is a lifelong pursuit. There's always more to learn, and as the business landscape continues to evolve, so too will our understanding of finance.
Well said. Now, before we move on to our final thoughts, I want to pose a question to you, and I'd encourage you to think about this as well. Imagine you're leading a team, or even an entire company. How could you apply these concepts from financial intelligence to create a more financially savvy and successful organization? That's a great question to consider. What are some key steps a leader could take to create that kind of financially intelligent culture?
One of the first things I think to realize is that you can't just assume everyone in a leadership position is already financially literate. Just because someone has a fancy title doesn't automatically mean they understand a balance sheet or can effectively analyze a cash flow statement.
Yeah, it's easy to fall into that trap of thinking everyone should just get it, especially when it comes to something as, fundamental as finance.
Exactly. But the reality is that many managers and executives are making decisions without a solid grasp of the financial implications, which can have some pretty significant consequences for their teams and the organization as a whole.
So how do you start to address that gap?
The book strongly advocates for incorporating financial literacy training into leadership development programs. It's about equipping leaders with the tools and knowledge they need to make sound financial decisions.
That makes a lot of sense. But it can't just be a one-time training session, right?
You're absolutely right. Financial literacy is an ongoing journey. The book stresses the importance of reinforcement and creating opportunities for leaders to apply these concepts in their day-to-day work.
So it's about creating a culture where financial discussions are the norm, not the exception.
Exactly. It could be something as simple as regularly sharing key metrics with the team and having open discussions about what those numbers mean. Think about how those numbers connect to the team's goals and how each individual's work contributes to the overall financial picture.
So it's about transparency and making sure everyone feels comfortable asking questions and, understanding how their actions impact the bottom line.
Precisely. And don't underestimate the power of visual aids. The book talks about using tools like financial dashboards to make those numbers more accessible and engaging. Instead of just looking at rows and columns of data, you can present the information in a way that, tells a story and highlights key trends.
It's about making those financial insights come alive.
Exactly. And remember that example we discussed earlier about strategically managing accounts payable? Well, a leader who understands that concept can empower their team to negotiate more favorable payment terms with vendors, which can have a real impact on the company's cash flow.
It's about connecting those financial concepts to real-world actions. I can see how empowering a team with that kind of knowledge and ownership could be a game changer.
It definitely can be. And it's not just about understanding the numbers, right? It's about creating a culture where people feel comfortable discussing financial matters openly and honestly.
So fostering a sense of trust and transparency is essential.
Absolutely. The more open and honest a company is about its financial performance, the more trust and accountability you build within the organization.
It's like they're saying, don't hide the numbers, embrace them, and encourage everyone to understand what those numbers are telling us.
Exactly. And when you have that shared understanding, you can start to unlock some incredible potential. The book even suggests involving employees in the budgeting process. Imagine giving your team a voice in how resources are allocated and empowering them to make decisions that align with the company's financial goals.
It's about moving away from that old school mindset of finance is someone else's problem and fostering a sense of collective ownership. When people feel like they have a stake in the financial success of the company, their motivation and engagement go up.
I couldn't agree more. And that shift in mindset can lead to better decision-making, improved performance, and ultimately a more successful and sustainable business.
We've come a long way in this deep dive into financial intelligence. We've explored those essential financial statements, unraveled the mysteries of those key ratios, and even ventured into the realm of capital expenditure analysis. But it's clear that financial intelligence is more than just mastering technical concepts.
You're absolutely right. It's about developing that critical thinking mindset, learning to ask the right questions, and using those insights to make informed decisions. It's about seeing beyond the surface of those numbers and understanding the story they're telling us.
And it's about empowering ourselves with the knowledge and tools to contribute to the financial success of our organizations and our own personal lives. Who knew we could have so much fun talking about financial statements?
It's been a real pleasure. And remember, this is just the beginning of your financial intelligence journey.
There's always more to learn, more insights to uncover, and more ways to apply this knowledge to create positive change. So stay curious, keep asking questions, and never stop exploring this fascinating world of finance and accounting.
Well said. Until next time, keep diving deep.